Hello, and thank you for joining me today for Real Estate, Religion, and You. My name is Sylvia Black, licensed real estate broker and owner of affordable homes and apartments in Williamsville. I'm licensed to preach and ordained as a minister, and I have my master's degree in sacred theological divinity. And I want to thank you for joining me today. Last week we talked about borrowing basics, what you don't know can hurt you. And a week before that we talked about free money for home buyers. This is a book that I compiled, and it lists various agencies, city, state, county, municipalities that offer free money for home buyers in the form of grants, subsidies, loans, down payment and closing cost assistance, and a host of other services available, including Section 8 home ownership voucher and weatherization programs, not limited to. I include the entire state of New York in this book, and anything out of New York State, I include the website where you can actually go and search for that information if it's not in the state of New York. And again, I want to thank you for joining me today. You can hit me up on YouTube at sblack3001 for free videos. Last month we talked about knowing and understanding your credit, which is very essential in terms of when you are searching for a home and you're looking to buy a home for the first time or for the second time, or as an investor if you're looking to invest in some real estate, which is what I also teach. Now, today we're going to talk on a continued basis. We'll go over this a little bit, but we're going to be talking today for the rest of the month about choosing a mortgage that's right for you. Now, I obtained these books from various government, state, city, and federal agencies, and what I do is I compile all the books that I've gotten, and I put them in a home buyer's kit, and that's what I call it, and I give it to you when you come to the workshop. There's a compilation of books. Sometimes I'll give out one book per week, whichever class that you're attending. If you've registered for the entire session of that, sometimes they usually run 6 weeks in succession. We also would include, then we can give you the entire package, and you just would bring in the book that you would need to refer to for that particular class. Now, I want to talk to you about choosing a mortgage that's right for you. It's very important and essential that we know what types of mortgages that are out there. When you go to a bank, to a lending institution, a mortgage company, a credit union, or any kind of lending institution, sometimes the words that they speak can be very confusing. And a lot of times it can be very intimidating when you go to these places, especially when you have people that do not want to explain anything to you about what the services are that they offer. A lot of times people they just don't have the time, they don't take the time, they don't, some of them want to make the money. And then you also have some that are actually nice and actually, give you the patience and the attention that you deserve. Just keep in mind that when you do apply for a mortgage and you qualify for one, you are the boss. You're the mortgage guy, the mortgage girl, she works for you now. Okay, so this is your opportunity to be an employer. Okay? Now, when you work for me, a real estate brokerage firm, and when I sell you a house, okay, I am not working for you. So you can consider yourself as my employer, okay, for that transaction. I give you the information that you need, and then you take advantage of the services and the products that are offered to you based on the decision that you make. After you've had the information that you need, and then you go ahead on and you make an educated decision on what you want to take advantage of. Now, if you're like most Americans, owning a home is very important to you. It's a major part of the American dream. Affordable Homes and other government agencies would like to help you understand the steps that you have to follow to reach that dream. Home ownership is a big responsibility, one that you will need to accept for many, many years to come. It's very much worth the effort, and we here at Affordable Homes and Apartments can help. You may not be familiar with a lot of products and services that we offer, but we hope that in the coming years that you will get more familiar with us, and we will get to know you just a little bit better. Okay? Now, you want to buy a home, and millions of Americans like yourself also want to, okay? But you want to be careful in finding out what the different types of mortgages are. and what mortgage is right for your budget. Okay, how big of a loan can you afford? Okay, how much money, will they loan you? What type of mortgage will you get? There are different types of mortgages, yes. Which mortgage is best for you and your future and your family? When we finish talking about what's in this guide, okay, it could be the next couple of weeks. We have 4 more weeks in the month. We'll probably be doing this at least in a 3-part series. Now, when we finish reading this, you will have most of the answers that you need for several questions that may come up in your mind. It's very important that you know the information that you need, and to be prepared for some of the questions that the lender was going to ask you when you actually apply for the mortgage loan itself after you've located a home. Okay, it's also important to know the information so that you can get an idea of how expensive the home you can afford before you buy. Okay, in short, we would like to help you move into your new home without a whole bunch of extra added expense. Okay, now Affordable Homes and Apartment I've written many other books, and of course this is one of them, Free Money for Home Buyers, and it's available on AffordableHomesAndApartments.com. Okay, now if you're not sure whether you're ready to buy a home right now, Affordable Homes offers financial management classes, which includes budget, debt, and credit issues. And we talk about a lot of the issues that you're going to face when choosing and making a decision on home buying. Do I want to buy a home now? Am I ready to buy a home? A whole lot of different things. How far am I away from actually buying a home? And a lot of people think that they have to have a lot of money. You have to be making, $20,000 a year, $30,000 a year in order to qualify for a loan. Well, you don't. A lot of the programs that I talk about in my book, Free Money for Home Buyers, actually talks to low income and moderate income individuals and families you may be working at McDonald's, or you could be working at Burger King, or you could be working behind the desk at a phone and still making $7 or $8, $9 an hour, $10, $11 an hour, and that's not a whole lot of money these days, because just as income has gone up, okay, so has rents. The average rents are somewhere like $750. And when you complete paying your rent for all of those years, what do you have to show for it? Absolutely nothing. You move out of the apartment. Some people don't want the responsibility of owning a home, and some people do. When something goes wrong, I call my landlord. My landlord fixes. People who don't make a lot of money. So what this does is this guarantees the mortgage to the lender. The lender says, "Oh, wow, okay, the government is going to guarantee this mortgage for me. So if I loan you the money, Mr. Homebuyer or Miss Homebuyer, the government is going to insure it and say if they default on their mortgage and they don't pay you back, then we will pay you back and take the home back." And then what the Housing Urban Development does is they put it on the market for whatever is left of the mortgage. You see, the government is not in the home buying and property management business. So they want to sell that house and get that money as quickly as possible. Affordable Homes, however, is in the property management business. We deal in real estate. They deal in money. Okay? Now, 5% down, sometimes, like I said, is possible in some cases. Sometimes conventional loans, and of course we're going to talk about these in details. Oh, by the way, the government loan is called an FHA/HUD mortgage, Federal Housing Administration Housing Urban Development mortgage. It's a government insured mortgages. Now, Fannie Mae and Housing Urban Development don't actually loan you the money. They insure the money that the lenders loan you. In order for the lender to be able to participate in these programs, the lender has to sign up with the government agency. And then the government agency will approve them. And so when you walk into the bank, if you say, "Are you an FHA approved mortgagee? Are you an FHA approved mortgagee? Are you a HUD approved mortgagee? Are you a SONIMA approved mortgagee?" Those are the kind of loans that you want to get, because those loans require less of a down payment. And of course, if you qualify income-wise, you can take advantage of some of the down payment and closing cost assistance programs that I list in here, which means that your down payment could be very little or nothing at all. Then don't forget about the grants that you can get to lower the cost of the home, okay? And we will get in detail about how to go about determining if this particular bank will be able to offer you that. And how do you go about taking advantage of it if they do? Okay? Now, consider upcoming expenses and closing costs in your down payment. Now, a lot of times, usually the first thing when you get a mortgage, we Affordable Homes would ask you, as well as any other real estate broker, we would require an earnest money deposit on contract. You see the house, you like the house. Okay, you have to already been pre-qualified for a mortgage. I'm not taking any money from you unless I know that you've been pre-qualified for a mortgage. Okay, and you say, okay, now I want to buy this house. Okay, now we're going to ask you for an earnest money deposit. And sometimes that could be as little as $500 of your own money. And that's when you sign the initial contract that says, I want to buy this house. You provide me with your pre-qualification certificate, and you also provide me with income. I ask you for income. I usually get 4 weeks of paycheck stubs, last 2 years of IRS forms, and a couple of other things as well. And then you give us permission, you sign a disclosure giving us permission to check these various sources. Okay? And then also the application itself, as well as the earnest money deposit. Now usually I ask for $500. Now, if the bank decides not to qualify you for the mortgage, you get that money back. Okay, but the more of your money that we have, the more, because then once we have a deposit from you, we stop advertising that house. Okay, so to make sure that the house, that you will be able to get it, we don't advertise it anymore. Okay, now putting less than 20% down often means that you will be required to purchase private mortgage insurance. Private mortgage insurance protects the lending institution in case you fail to make the payments on the mortgage. Now this qualifies under most other mortgages, including the government mortgages and the state mortgages that I just mentioned to you. This insurance helps you buy your home years sooner than you ordinarily would be able to, because you don't have to save the whole 20% down payment. That's where Sony Mar comes in at. That's where HUD comes in at. That's where FHA comes in at. And a host of other government agencies. There are also county municipalities, as well as city municipalities, that also offer the assistance as well. And we can go into detail about that. And if you want to know which ones they are, you can get a copy of my book, Free Money for Home Buyers, and that's available on AffordableHomesAndApartments.com. Okay? Now, some types of mortgages for which you put less than 20% down, as I say, do not require private mortgage insurance. These include loans that are insured by the federal government, such as FHA or VA loan. That's right, I almost forgot about a VA loan, Veterans Administration loan. Veterans Administration, they also insure mortgages against the borrower. Okay? So if you as a veteran, you default on your mortgage, the Veterans Administration will pay the bank back, repossess the house, put it on the market, and sell it for what's left, sometimes taking a loss. Now, your state may also offer special mortgages for low and moderate income home buyers that use state-approved mortgage insurance programs, and that's talked about in my book, Free Money for Home Buyers, available on AffordableHomesAndApartments.com. And I'm sure we're going to be talking about this next week again. Now, consider upcoming expenses and closing costs in your down payment. How much money do you feel comfortable applying to your down payment? In other words, how much extra cash do you feel that you have? At that point, okay, you will have, I don't know, usually a down payment is required once you commit to buying that house. Once the bank says, we're giving you a commitment now, that we're committing to loaning you this money, now you provide the down payment and the rest of the documents, because most of the time I gather all the documents ahead of time so I can already supply them to them, so there's no more waiting that's necessary. You know what I'm saying? I do that as a process to help speed up the process. But it usually takes about 2 months from the time you actually sign that contract, okay, or get a mortgage commitment from the lender, until the time that you get the key to your new home. And the reason is because mortgage companies want to make sure that they're doing the right thing by you. And it's important that you are being protected as the future home buyer. So it takes that long to make sure that all the I's are dotted and all the T's are crossed. Okay, you multiply that by the number of hours that you work, okay, and then you multiply that, because that's weekly. Then you take your weekly earnings and you multiply it by 52 weeks, and you come up with your annual income. And then you take that and you divide it by 12 months in the year, and you come up with your monthly income before taxes, your gross monthly income. Then you take that amount of money and you multiply it by 28. And that equals the maximum allowable monthly household expense that you can afford. Okay, now you calculate your long-term debt. This is the next step. Next, you will need to consider the long-term debt that your household owes. Any installment or revolving debts, such as credit card or store accounts, that you will take more than 10 months to pay off are considered long-term debts. Rent is long-term debt. Okay, rent-a-center bills, long-term debt. Car payments, long-term debt. Credit cards, long-term debt. Other debts may be included. Debts may include car payments, student loan, alimony, child support payments, etc. Totaling your existing monthly payments on long-term household debts. Okay, but be sure to disclose all the long-term debts on each of the borrower. And we have a long-term monthly household debts worksheet for you also. Now, in this amount of your monthly debt payments, you just calculated more or less than what a lender will allow. Okay, that's easy to find out. To calculate your monthly allowable debt, complete the exercise. Take your total gross monthly income, which is how we did it. You take your hourly wage, you multiply that by the number of hours you work, multiply that by 52 weeks, and then divide that by 12 months. So now you have your total gross monthly income, and then you multiply that by 36% now, instead of 28. Now this equals your maximum allowable combined household and monthly debt. Okay, now you can easily see if the actual long-term debt you have is more or less than 36% if you are that you are allowed. Simply compare your sum total in the long-term monthly household debts worksheet, okay, to the 36% figure you just calculated. If your long-term monthly debt is greater than 36% of your monthly income, you may have to put off some debts before you apply for a loan. Okay, now double check your figures. Now that you've calculated the income and debt ratios, let's double check your figures. Okay, your monthly household expense, including mortgage, principal, and interest, property taxes, hazard insurance, and if applicable, mortgage insurance, should total no more than 28% of your gross monthly income. Your total long-term monthly debt, including your household expenses and other debt, should total no more than 36% of your gross monthly income. You check the figures you calculated against the chart that I'm going to provide for you. As you review these figures, remember that your allowable monthly payment amounts are flexible and can be increased somewhat depending on your situation. Okay, I also have an allowable monthly housing expense and monthly rent based on your income sheet. Okay, now let's go over that briefly. Okay, we have gross annual income. Let's say if you're making $20,000, the allowable weekly household expense is $467. Your allowable long-term monthly debt is $600. And this is an estimate. This is based, it's an estimate. Okay, if your gross annual income is $25,000, allowable monthly household expense is $583, and your allowable long-term monthly debt is $750. Now I'll explain that in detail to you. Okay, let's go on down. Let's go to $50,000. Your allowable monthly household expenses $1,167. Okay, your allowable long-term monthly debt is $1,500. That means everything that you're paying out. Your car loan, they don't include gas and electric in that. But your car loan, any long-term expenses, your car loan, your mortgage, all of that, that's included. And now this chart shows you how high your monthly housing expenses and your long-term monthly debt can be based on your income. Allowable monthly household income expense includes mortgage, principal, and interest, property taxes, hazard insurance, and if applicable, mortgage insurance. All of this is based on the price and the cost and the expenses of the house that you're looking to purchase. Okay? Okay, now, if you've ever shopped for credit card or a car loan, which we talked about last month, you know that getting the best interest rate is a very important part of a shopping decision. The same is true when you shop for a mortgage. As with any loan, you lower your interest rate, and the lower your monthly payments. Okay, as with any other loan, the lower your interest rate, the lower your monthly payments. Okay, or another way to look at it is the lower the interest rate, the more buying power you'll have. Okay, with lower rates, you can borrow more money for approximately the same monthly payment. Okay, here are some points to keep in mind when you compare interest rates between loans. Okay, shorter term loans offer lower interest rates. You can choose the length of the loan that you want. Keep in mind that each type of mortgage loan may carry a different interest rate. As a general rule, the shorter the term of the loan, the lower the interest rate you will pay. So a 15-year fixed rate mortgage usually has a lower interest rate than a 30-year fixed mortgage rate does. A fixed versus an adjustable interest rate. Also keep in mind that you can choose a mortgage with an interest rate that is fixed for the entire term of the loan, or an interest rate that adjusts during the loan term. And that could be advantageous or disadvantage. If your income goes down, your interest rates can go down. However, the rate could go up too at a time when your income goes down. Okay, a fixed rate loan gives you the security of knowing that your interest rate will never change during the entire term of the loan. An adjustable rate mortgage, called an ARM, an ARM, has an interest rate that will vary during the life of the loan, with the possibility of both increases and decreases to the interest rate, and consequently to your mortgage payment. The ARM frequently offers a lower initial interest rate than a fixed rate mortgage. However, when comparing interest rates between ARMs and fixed rate mortgages, you need to know the adjustable rate mortgages interest rate caps, the maximums, the highest interest that they can charge. There is a cap or limit for how much the interest rate can increase to, the maximum the interest rate can go up to, over the life of your loan, and the cap for how much the interest rate can increase at each adjustable date. And you will know that ahead of time if you choose an adjustable rate mortgage. These caps tell you the maximum interest rate, and you could be required to pay during each adjustment period and over the mortgage document, the paper that says you have a mortgage, because now the deed says you and the bank owns the house while you're paying the mortgage. But when you get that satisfaction of mortgage piece, now the deed will say only you own the house. You can burn that certificate that has your name on it and the mortgage company's name. Okay? And only the one with your name on it is the one that'll actually be the one that'll last. Now it belongs to you, free and clear, and you can have a mortgage burning ceremony. Okay, if you've done the exercises in this guide, and we will do them again together, okay, and now you know how much you can afford and spend on the monthly mortgage payments. Remember, 28% of your gross monthly income, and you also know whether your present debts and projected housing costs are within a comfortable range, 36% of gross monthly income. You've compared your monthly housing allowance to the monthly loan payments for the mortgage amount you are thinking of borrowing. Okay, you've been able to do this by using the monthly loan payment table that we went over. Okay, and you will be using it again. You'll go and get a copy of this book so that you can have it and you can refer back to it on a regular basis. Excuse me, this is part of the home buyer's kit that I offer. Okay. Now you may wish to look into a special type of adjustment rate mortgage that doesn't adjust your interest rate until several years later after you take out the loan. These loans offer you several years of fixed payments before there is an interest rate increase. You can get 3, 5, 7, or 10 or fixed period ARM. Okay, this means that the interest rate would be the same for the first 3, 5, 7, or 10 years, and then at the end of the chosen fixed rate period, your interest rate would adjust every year. Okay? This type of adjustment rate mortgage protects you against rapid interest rate increases in the early years of your loan. ARM, sometimes called the two-step, provides the benefit of initial low rates and stability of longer-term financing. Now there's also what we call balloon mortgages, and no, it's not a real live balloon. That's a terminology that is called balloon. Now balloon loans offer low interest rates for shorter term financing, usually 5, 7, or 10 years. At the end of this term, they require refinancing or paying off the outstanding balance with a lump sum payment. Balloon mortgages may be suitable if you plan to sell or refinance your home within a few years and you want a fixed low monthly payment. The advantage they offer is an interest rate that is lower than fully amortized fixed rate mortgages. For example, your initial interest rate may be 6.5%, and you would pay that rate for the first 5, 7, or 10 years, depending on the term of the balloon loan. Then your entire outstanding loan balance would be due to the lender, or you might have to pay a fee to refinance your loan at the prevailing interest rate. However, ask about all the conditions for a refinance option at the beginning of the balloon term before you get the mortgage. With some balloon mortgages, the lender doesn't guarantee to extend the loan past the balloon date. If he does feel that you will be able to meet all the financial conditions, or think the balloon term may be up before you are ready to move, this type of loan may not be appropriate for you. Other types of mortgages to consider. Special loan programs. Special loan programs often exist to help first-time homebuyers like yourself. With some of these programs that you may be able to accept a gift from a relative or borrow a portion of the money you will need for the down payment and closing costs from a local nonprofit organization or government agency. Okay? With others, you may be able to get grants or other funds that you will not have to repay and can use to cover some of the costs. If you don't qualify for a mortgage based on some of the traditional underwriting factors described earlier, you may want to find lenders who offer special mortgage loans like these. These loans allow you to use a greater percentage of your income toward monthly housing expenses, and you will not require you to have 2 months of cash in reserve at closing. If you don't have a traditional credit history, you can show you have a good credit history using your rent and utility receipts. Now that is called alternative credit. Alternative credit is when you have no credit at all, no established credit. Now alternative credit is usually used, you get 4 items. Okay, 4 items that you pay on a regular basis, usually long term, more than 10 months. Okay, and that could usually be your gas bill is 1, your electric bill is 2, you can use your cable bill is 3, and your phone bill is 4. You could use your car loan as 1 if you like to do that. Any of 4 items can be used as alternative credit. And then what that does is they investigate it to determine if you've been paying those bills consistently and on time and what have you. And just as if they would check to see your credit card payments were paid. Pay it all. Okay? Oh, you might say, hey, I don't want a rental unit. Well, that's fine. I will give you the ups and downs of that, the goods and the bads. And then with all the information that you will have, you make an educated decision. But remember, you are going to be responsible for the decision that you make. You know, I'm only the intermediary, the licensed real estate broker. I'm going to help you through the process the best way that I can. And it's only if you need and want my help. If you don't want my help, I'm out. But if you need my help and you want my help, I will offer it to you. But my final question to you is going to be, what do you want to do?